Hello everyone and welcome to Educate 247. This is the 21st lecture in the series on financial awareness, and this lecture is important for SEBI Grade A as well as RBI Grade B 2020. In this lecture we'll be covering SEBI exit option guidelines for real estate investment trusts and infrastructure investment trusts. But before moving forward, Educate 247 brings you SEBI Grade A 2020 crash course, which features around 5000 plus MCQs with concise content and live doubt sessions. So you can log on to the website and apply coupon code SEBI to get 1500 rupees off on the course. Now, before moving forward, let us understand more about real estate investment trust and infrastructure investment trusts. So, what are real estate investment trusts or REITs? REIT is a process to generate funds from a lot of investors to directly invest in properties like offices, residential units, hotels, shopping centers, warehouses, etc. All REITs will be listed with the stock exchanges as they would be structured like trusts. Consequently, REIT assets will be held with independent trustees for unit holders or investors. Coming to what is the role of the trustees in an REIT? The trustees of the REITs have defined duties which typically involve ensuring compliance and adherence to all the applicable laws which protect the rights of the investors. Understanding more about the objectives of REITs, that it aims to provide the investors with dividends that are generated from capital gains accruing from the sale of commercial assets. The trustees distributes 90% of the income among its investors via dividends. Apart from the minimum entry level, a REIT is supposed to provide diversified and safe investment opportunities with reduced risks and under a professional management to ensure maximum return on investments. Coming to the advantages, 90% of distributable cash is provided in the form of dividends at least twice in a year. The REITs will showcase the full valuation on a yearly basis and will also update on a half yearly basis, thus providing the transparency feature. According to the guidelines, REITs will have to invest in a minimum of two projects with 60% asset value in a single project, thus depicting diversification. At least 80% of the assets will have to be invested into revenue generating and completed projects, while the remaining 20% includes under construction projects, equity shares of listed properties, mortgage based securities, and equity shares that derive a minimum of 75% of the income from government securities. Coming to the background, in 2014, SEBI had amended the SEBI Real Estate Investment Trusts Regulations of 2014, which allowed them to issue debt securities apart from raising equity. The amendment was part of the government's move to revamp the real estate sector by allowing more investor participation. Now, let us understand more about infrastructure investment trusts. An infrastructure investment trust is like a mutual fund which enables direct investment of small amounts of money from possible or individual investors in infrastructure to earn a small proportion of the income as a return. The infrastructure investment trusts work like mutual funds or real estate investment trusts in features. The infrastructure investment trusts can be treated as a modified version of the real estate investment trusts, which are designed to suit the specific circumstances of the infrastructure sector. SEBI had notified the SEBI Infrastructure Investment Trust Regulations 2014 on September 26, 2014, providing for a registration and regulation of infrastructure investment trusts in India. The objective is to facilitate investment in the infrastructure sector. They are similar to mutual funds in structure and can be established as a trust and be registered with SEBI. An infrastructure investment trusts consist of four elements, which includes the trustee, the sponsor, the investment manager, and the project manager. The trustee who inspects the performance of an infrastructure investment trust is certified by SEBI, and he cannot be an associate of the sponsor or manager. Sponsors or people who promote and refer to any organization or a corporate entity with a capital of 100 crores, which establishes the infrastructure investment trusts and is designated as such at the time of application made to SEBI and in case of public-private partnership projects. Promoters or sponsors jointly have to hold a minimum of 25% for at least 3 years in the trust, excluding the situations where an administrative requirement or concession agreement needs the sponsor to hold some minimum percent in the special purpose vehicle. In these cases, the total value of the sponsor holding in the primary special purpose vehicle and in the infrastructure investment trust should not be less than 25% of the value of units on post-issue basis. An investment manager is an entity or a limited liability partnership that supervises assets and investments of the trust and guarantees the activities of the trust. Project manager refers to the person who acts as the project manager and whose duty is to attain the execution of the project, and it indicates that the entity is responsible for such execution and accomplishment of project landmark with respect to the agreement or other relevant project document. Now, let us understand the difference between the two, that is, the real estate investment trust and the infrastructure investment trust. In terms of income stability, REITs provide stable income and certain yield as 80% of the assets are income generating properties that have long term rental contracts. Coming to infrastructure investment trusts, the cash flows are less certain as they are dependent on various factors affecting the daily capacity utilization and scalability of tariffs. The real estate investment trusts are better insulated from regulatory and political risks. REITs hold land and buildings with a view on a freehold basis or on lease from a government authority, while the infrastructure investment trusts have concessions given on infrastructure projects which are more prone to regulatory changes and political interference. Coming to property ownership, the real estate investment trusts underlying assets see growth in value over time and have high terminal value. They own the property leased out of whose value grows over time like all real estate classes. Whereas the infrastructure investment trusts comprise of concessions where the projects are returned to the authority or are rebid post the concession period. While the REITs are more accessible to small investors and have higher liquidity due to lower unit price and trading lot, the InvITs have bigger trading lot size and thus poor liquidity. Now, coming to the news, SEBI has recently issued procedural guidelines for providing exit options to the descending unit holders of real estate investment trusts and infrastructure investment trusts. A unit holder is an investor who owns one or more units in an investment trust. A unit is equivalent to a share or a piece of interests. Unit holders are afforded specific rights that are outlined in the trust declaration, which governs the actions of the trust. The most common type of unit trust is in investment vehicles which pool funds from the investors to purchase a portfolio of assets. So, in this case, the investment vehicle which pools funds will be investment in case of real estate and infrastructure. So the guidelines said that an acquirer providing exit options to descending investors must facilitate the tendering of units by them and settlement of the same must be done through a way of stock exchange. Tendering here means the process whereby shareholders will submit their shares or securities in response to a takeover offer. SEBI has also mandated that the acquirer must appoint a merchant banker for the exit offer and should issue a public notice stating its intention to provide an exit route to the descending unit holders. A merchant banker has specialized skills in mobilizing funds from private investors and can help both large corporations as well as SMEs to access funds for ensuring better utilization of financial resources. A merchant banker usually refers to a firm or an organization involved in all aspects of issue management. Their services includes providing consultancy or advisory services to corporates for issue management, making arrangements for buying, selling or subscribing to the shares in an issue, or other consultancy or services such as underwriting, analysis and advice related to merger and acquisitions, arranging offshore funding or venture capital. In India, SEBI classifies merchant bankers into four categories based on permissible activity and capital adequacy norms. As per SEBI regulations in India, it is mandatory for a merchant banker to have a certificate of registration issued by SEBI in order to offer merchant banking services. Some of the leading merchant bankers in India includes SBI Capital Markets, Punjab National Bank, IFCI Financial Services, ICICI Securities, Axis Bank, and Bajaj Capital. Coming to the news, SEBI has mandated the acquirer to appoint a merchant banker for the exit offer and should issue a public notice stating its intention to provide an exit route to the descending unit holders. The banker then must convene a meeting of the unit holders for voting, and the process must be completed within 3 days from the cutoff date. Next, the banker must intimate the outcome of the unit holders meeting to the acquirer in the stock exchange, along with the number of descending unit holders and the total number of units which were held by them as of the cutoff date within 48 hours of the last day of voting. The acquirer must also create an escrow account in which it should deposit the required amount based on the list of descending unit holders provided by the banker. An escrow account is a financial instrument in which an asset or escrow money is held by a third party on behalf of two other parties that are in the process of completing a transaction. Escrow accounts can hold money, securities, funds, and other assets. Setting up an escrow account is a complicated process, but technologically advanced escrow service providers of today create easy to access platforms. Democratizing the escrow service is a safe and secure payment mechanism. In simpler terms, an escrow account is a third party account where funds are kept before they are transferred to the ultimate party. It provides security against scams and frauds, especially with high value and dispute prone areas such as real estate. Usually, in a financial transaction, the seller's concern is regarding the assurance for receiving the payment, whereas the buyer is concerned about their investment and receipt of goods in sound condition. This is easily solved with the use of escrow. The party receiving the money cannot make withdrawals from an escrow account until the set of obligations are fulfilled. Hence, this proves to be a powerful financial instrument that removes trust-based issues in sectors such as real estate. So, in this case, the acquirer is also required to create an escrow account in which it should deposit the required amount based on the list of descending unit holders provided by the banker. The banker must list the tender period for tendering the units in the exit offer. The acquirer must also ensure that the payment is made within 3 days from the last date of the tendering period. So that's it for this lecture, but prior to ending it, I'd like to tell you that Educate 247 brings a comprehensive course for RBI Grade B 2020, which covers topics such as economic and social issues, finance and management, along with comprehensive coverage of current affairs in the form of MCQs. So you can log onto the website and avail the benefits of the full video course. Thank you and happy learning.